Now, you might wonder to yourself, as many of us do, why would someone even give up an interest rate of 2.5%, 3%, 4% for a rate of 5%, 6%, 7%? And the reality is there's a lot of factors that come into play here. We've talked about many of them here on this podcast. Some of the obvious ones are just home prices, right? Like maybe they're in an area where their home's gone up a lot in value, they have a ton of equity, and they don't mind moving to an area that's more affordable, using some of that equity, paying cash for a home, or substantially lowering, their mortgage amount as they prepare for retirement or something like that. Property taxes is a huge factor. I'm here in Washington State. They just continue to jack up property taxes, so that could be a reason why people might move. Insurance costs. I mean, certain states, it's almost impossible to get insurance. And you would think, I mean, man, in years past, insurance was not even a factor. It was just, it's just one of the small pieces of the PITI payment. But now insurance is a major factor when people are buying a home, especially in certain states where they have a lot of natural disasters, whether it be fires, hurricanes, earthquakes, things of that nature. You've seen, whole insurance companies pull out of certain markets and premiums go up just to insane levels. So all those things are very relevant factors that could force someone, or not force them, but urge them to maybe have to sell their house. And the good news is for those home buyers is almost all of them are in a much better financial position with their house than they've ever been, especially way better than it was before the housing crash when, 23% of all homes were underwater at that time. Look at this chart, the Great American Cash Cushion, they call it. Look how few people have negative equity. It's so small, you can't even see it. But at the very, very top, above that gray section, there's a little tiny red section. And those are people with negative equity. It's basically zero. And if you look at people with greater than 65% loan to value, it's the large red section at the bottom. I mean, that's incredible how much equity people have in their homes. We talk about this all the time when we're talking about cash out refinances and the like. This just shows you in a graph that people have opportunities to do what they want to do because they have this huge cushion. The other big factor, and I mentioned this briefly in the last episode, it's credit scores. We hear a lot about people that are maxed out on their credit cards and consumer debts at an all-time high. That's true, but if you look at the outstanding mortgages over the last 15 years, the majority of home buyers that were purchasing homes have a 720 credit score or higher. So I'll throw that graph up here, just higher credit scores dominate mortgages now. So you can see the gray area is people over 760. Really, you don't get into the even 660 and below are those two little tiny, lines at the bottom, the dark gray and the red. So, people have more options when it comes to what they do because they have better credit scores.